All right, ready to dive into the world of intelligent investing?
Let's do it.
Today, we're cracking open Benjamin Graham's The Intelligent Investor, the classic, updated by Jason Zweig.
A must read for any investor.
Absolutely. Think of this deep dive as your cheat sheet
Yeah.
to understanding the strategies that made Graham a Wall Street legend.
And what's fascinating is Graham wasn't just some academic,
Yeah.
He was out there making real investment decisions, thriving during crazy market swings.
He even scored a 250% return in a single day back in 1919.
Oh, yeah, but that's a story with a twist, right?
Oh, definitely. What happened?
Well, that company turned out to be a complete fraud, exposed just a few months later.
Oof, talk about a roller coaster.
Yeah, but that's why his insights are so valuable.
Right.
He learned from his wins and his losses.
Yeah.
And you can really see that in his writing.
So let's get to the core of it. What does Graham actually mean by intelligent investing?
It's more than just picking stocks.
Yeah.
He's definitely not talking about chasing hot tips or trying to time the market perfectly.
Right.
It's really all about a mindset. It's about building a fortress around your wealth.
Okay, I like that.
So you're not trying to, hit home runs. You're playing the long game, focusing on minimizing losses and letting your investments grow steadily over time.
It's more like building a solid foundation, brick by brick.
Exactly. Making decisions based on thorough analysis and a deep understanding of the businesses you're investing in.
Not on, emotions or hype.
Exactly. No fleeting emotions or market hype.
And this is where Mr. Market comes in.
Oh, yes.
Now, I'll admit, when I first encountered this analogy, it seemed a little, strange.
Yeah, I get that.
It's like thinking of the stock market as a person, right?
It might seem a little odd at first, but it's a brilliant analogy. Picture Mr. Market as this, unpredictable character who shows up every day,
Okay.
offering to buy or sell your stocks at, wildly fluctuating prices.
Yeah.
Driven by, pure emotion. So some days he's euphoric, convinced everything's amazing, willing to pay top dollar.
Right.
Other days he's doom and gloom, desperate to unload his holdings for pennies.
So it's like having a business partner with extreme mood swings.
Exactly. You never know what kind of offer he's going to throw at you.
Right. So how do we avoid getting caught up in those mood swings? Even the most level-headed investor can feel their pulse race when they see their portfolio taking a dip.
Absolutely. And that's where the margin of safety comes in. Think of it as your financial buffer,
Okay.
a cushion that protects you, even if your analysis wasn't perfect or Mr. Market throws a tantrum.
So you're buying stocks for less than they're actually worth.
Precisely. Like buying a house. Would you pay full price knowing the appraisal could be off or the market could cool down?
Probably not. I want some wiggle room, just in case.
Exactly. That's the margin of safety. You're building in a discount to protect yourself from the downside.
So it's like haggling with Mr. Market, even when he's feeling overly optimistic.
Exactly. And one of the best ways to find those bargains is to really do your research. Look for companies that are, temporarily out of favor, maybe due to some short-term setback or something like that.
So their underlying business is still solid. They just hit a bump in the road.
Right. And because the market tends to overreact to good and bad news, these temporary dips can create amazing buying opportunities.
It's like finding hidden gems everyone else is overlooking.
Precisely. This is where intelligent investors really shine. They look past the noise and hype.
Right.
Focus on those fundamentals and identify opportunities where the reward outweighs the risk.
This is great in theory, but how do we put this into practice? What are some concrete steps listeners can take to start applying these concepts?
First, develop a business owner mentality.
Okay.
Don't just think of yourself as someone who trades stocks. Think of it like you're buying a piece of a real business.
So shifting from short-term speculation to long-term ownership.
Exactly. When you view yourself as a business owner, you start to think differently. You care about the company's long-term prospects, their management team,
Right.
their competitive advantage, and their ability to, make money over time.
This all makes sense, but for someone who's not a financial expert, analyzing a company can be pretty daunting. Where do you even begin?
Well, that's where Graham's emphasis on financial literacy comes in.
Okay.
He believed that intelligent investors should be able to read and interpret financial statements.
Right.
Things like balance sheets, income statements.
So getting comfortable with the number.
Exactly. And it's not as complicated as it sounds. Think of financial statements as a company's report card. like a snapshot of their financial health.
Okay.
They tell you about their assets, their liabilities, revenues, expenses, and cash flow.
So it's like getting a behind-the-scenes look at how the business is actually performing.
Precisely. And by understanding these statements, you can evaluate a company's financial strength, their profitability, and their growth potential.
Now, you mentioned earlier that Graham wasn't a fan of chasing hot tips or trying to time the market.
That's right.
So he didn't believe in that whole buy low, sell high thing.
Well, he believed market timing was a fool's errand. It's virtually impossible to consistently predict the market's ups and downs.
So what's the alternative? Just buy and hold no matter what.
Well, Graham wasn't advocating for blind faith either. He believed in being proactive and taking advantage of market fluctuations, but not in a speculative way. He suggested a concept called dollar cost averaging.
Okay, I've heard that term before, but I'm not entirely sure what it means.
It's a really simple but powerful strategy.
Huh.
Instead of trying to time the market perfectly, you invest a fixed amount of money at regular intervals, regardless of what the market is doing.
So it's about having a consistent plan and sticking to it, regardless of the market's mood swings.
Exactly. This approach helps smooth out the volatility,
Okay.
allowing you to buy more shares when prices are low and fewer shares when prices are high.
That sounds like a smart way to avoid getting caught up in the emotional roller coaster of the market.
Exactly. And it's a strategy that anyone can implement,
Okay.
regardless of their level of experience or investment capital.
This all makes a lot of sense. But I'm curious, what about those investors who are a bit more, shall we say, adventurous? Did Graham have any strategies for those who are willing to take on more risk?
He did. He outlined some more advanced approaches for what he called enterprising investors. These are individuals who are willing to put in the time and effort to uncover those hidden gems that the market has overlooked.
All right, now we're talking. What kind of strategies did he have in mind?
One approach he suggested was looking for net stocks. Now, these are rare finds, but they can be incredibly lucrative.
Okay, so what exactly are we looking for with these net stocks?
Essentially, you're searching for companies whose stock price is actually lower than the value of their net current assets. Imagine a company with $10 per share in cash and other readily convertible assets, but its stock is trading for only $5 per share.
Wait, so you're saying you could buy the company for less than the cash it has on hand?
It sounds crazy, right? But it does happen. Of course, this kind of investing requires a deep dive into financial statements and a keen eye for identifying undervalued assets.
So, not exactly a passive approach.
Definitely not. But for those who are willing to put in the effort, these opportunities can yield significant returns.
I'm starting to see why Graham's book is considered a classic. He really provides a framework for intelligent investing, regardless of your risk tolerance or level of experience. But before we get too deep into those more advanced strategies, let's take a step back and address some common investing myths that Graham debunks in his book.
That's a great idea. He tackles quite a few misconceptions that can lead investors astray.
For example, what about this age-old adage of buy low, sell high?
Ah, yes, the holy grail of investing. But Graham was skeptical about the idea of market timing. He believed that it's incredibly difficult, if not impossible, to consistently buy at the absolute bottom and sell at the absolute peak.
So what's the alternative? Just buy and hold forever?
Well, Graham wasn't opposed to selling, but he believed in making those decisions based on careful analysis and a long-term perspective, not on trying to predict short-term market movements.
So it's about being patient and disciplined, rather than trying to outsmart the market.
Exactly. Another myth he tackles is this idea that higher returns always come with higher risk.
Wait, really? I always thought those two were inseparable.
It's a common misconception, but Graham argued that risk is relative. It depends more on the investor's financial equipment, their knowledge, experience, and temperament than on the inherent risk of the investment itself.
Okay, I'm intrigued. Can you elaborate on this financial equipment idea?
Imagine your financial equipment as a toolbox. A seasoned investor, someone who's been through multiple market cycles and has a deep understanding of financial principles, will have a full set of tools. They'll be able to analyze companies, assess risk, and make informed decisions. Now, a beginner investor might only have a hammer and screwdriver. They're still learning the ropes and might not be equipped to handle more complex investments.
So it's about knowing your limitations and investing accordingly.
Exactly. And as you gain experience and knowledge, your financial toolbox expands, allowing you to take on more sophisticated investments. But even then, it's crucial to always prioritize a margin of safety.
This all makes a lot of sense. but it also highlights how important it is to continuously learn and adapt as an investor, right?
Absolutely. And Graham emphasized that throughout his book. He believed that intelligent investing was a journey, not a destination. It's about constantly seeking out new knowledge, challenging your assumptions, and adapting to the ever-changing landscape of the market.
So it's not just about mastering a set of rules, it's about cultivating a mindset of continuous learning and improvement.
Precisely. And that's one of the most valuable lessons that Graham's book offers.
Hmm.
It's not just a guide to picking stocks, it's a roadmap for becoming a more intelligent investor no matter where you are on your journey.
Well, this has certainly given me a lot to think about. I'm eager to dive deeper into some of Graham's specific strategies and see how they can be applied in today's market.
Me too.
But maybe we can pick that up in our next part.
Sounds good to me.
All right, we'll be back soon with more from The Intelligent Investor. Stay tuned.
Looking forward to it. So, ready to put on that enterprising investor hat?
Oh, yeah, absolutely. Let's dig into some of Graham's more advanced strategies.
All right, sounds good. We talked about those net stocks before.
Right, those rare finds.
Yeah, exactly. What are some signs a company might be trading below its net current asset value?
That's a great question. What should we be looking for?
Well, you have to really dig into the financial statements, but
Right.
some key things are like companies with low debt, consistent earnings, and assets that are easily valued, like cash or inventory.
So you're looking for companies that are fundamentally sound, but maybe the market's overlooking them for some reason.
Exactly. Graham also recommended looking into what he called special situations, things like mergers and acquisitions,
Right.
or reorganizations.
So things that are happening that could shake things up a bit.
Yeah, exactly. These events can, create opportunities for savvy investors.
You need a pretty good understanding of how those corporate events can actually impact stock prices.
You do, but that's where your financial equipment comes in. Remember, the more you learn,
Yeah.
the more experience you gain, the better equipped you'll be to handle these things.
So it's all about building up that knowledge.
Expanding that toolkit.
Okay, so let's shift gears a bit. Let's talk about diversification.
Okay, sure.
No, don't put all your eggs in one basket, right?
Investing 101.
Absolutely.
Yeah.
But Graham takes us even further. He suggests a specific asset allocation for what he calls the defensive investor.
Right, someone who's prioritizing safety,
Yeah.
and capital preservation.
So what's the magic formula? What does he recommend?
At least 25% in bonds and a maximum of 75% in stocks.
So even the most risk-averse investor should still have some skin in the game with stocks.
That's right. Stocks offer that potential for growth that bonds typically don't, and over the long term, that growth is important. But, of course, it comes with more volatility.
Okay, so let's talk bonds for a sec. What should someone prioritize when picking bonds?
Safety and stability should be your top priorities. Stick with high-quality bonds like those issued by the U.S. government or financially sound corporations.
Nothing too risky or out there.
Exactly. Keep it simple. He also suggests looking into tax-free municipal bonds.
Oh, right, because then you get to keep more of your earnings.
Exactly. Now, on the stock side, Graham really pushes a value-oriented approach, finding those undervalued companies Mr. Markets missed.
And that ties back into the margin of safety idea, right?
Absolutely. It's all connected. Graham believed you could identify those bargains
Right.
by carefully analyzing a company's financials.
Okay.
He liked to look at metrics like the current ratio, for instance.
Can you explain that one a bit further? I think some folks might not be familiar with that.
Sure. So imagine a company has $100 in, let's say, current assets. These are things like cash, receivables, inventory. And then they have, let's say, $50 in current liabilities like debt payments and accounts payable. So to find the current ratio, you simply divide the assets by the liabilities.
So in that example, it would be 2.
Exactly. And a ratio of 2 or higher is generally considered pretty healthy
Okay.
because it means they have enough to cover those short-term debts.
So higher ratio, less risk.
Exactly. Graham believed that focusing on these undervalued companies with strong financials was the key to long-term success.
So it's finding that balance between a good deal and safety.
You got it. And Graham always emphasized that intelligent investing isn't just about, crunching numbers.
Right.
It's about understanding the psychology of the market, too. Remember our friend, Mr. Market?
Oh, always lurking.
Yeah, exactly. And Graham believed that understanding his emotional swings was crucial to making smart decisions. When the market's euphoric, it's easy to get caught up in the hype.
Like you can do no wrong Every investment's a winner.
Yeah, and that's when you need to be most careful. Remember, the market is a voting machine in the short term.
Mm-hmm.
But in the long run, it's a weighing machine. It reflects the true value of the business.
So tune out the noise and focus on what's really going on under the hood.
Exactly. That's where the margin of safety is so important.
Right.
It helps you stay grounded when things are crazy and keeps you from making those impulsive decisions.
It's like a safety net.
Exactly. Speaking of staying grounded, Graham also talked about patience.
Mm-hmm.
Time is the investor's greatest ally.
So let your investments grow. Don't tinker too much.
Right. Resist the urge to chase the latest hot stock.
Easier said than done sometimes.
It is. He believed it was like planting seeds and letting them grow.
So don't check your portfolio every 5 minutes.
Exactly. Trust the process. Let time do its thing.
This all makes sense, but for someone just starting out, it can feel overwhelming. Where do they even begin?
That's a great question. One of the best things is to start developing your financial literacy. Read books, articles, websites about investing.
So embrace that lifelong learning.
Absolutely. And you don't have to become an expert overnight. Just start with the basics and build from there.
It's like building a house.
Hmm.
Start with the foundation and add from there.
That's a great analogy. And just
Yeah.
like building a house, it takes patience, discipline,
Hmm.
and a commitment to the process. And remember, you don't have to do it alone. There are lots of resources out there.
Like what? What are some examples?
Well, Graham's book, for starters,
Of course.
it's a classic. There are tons of websites, blogs, podcasts, all about investing.
Okay.
And don't underestimate mentorship.
Finding someone who's been there, done that.
Exactly. Having a mentor, a financial advisor,
Right.
or even a friend who really understands the market can be really helpful.
Like having a coach in your corner.
Exactly. Remember, investing is a marathon, not a sprint. It's about making smart choices over time
Yeah.
and not getting caught up in those short-term market swings.
So stay focused, even when Mr. Market's trying to throw us off.
Exactly. That's the essence of intelligent investing, according to Graham.
This has been incredibly insightful. I feel like I'm understanding his philosophy so much better.
Good. I'm glad to hear that. Remember, this is just the beginning. There's always more to learn in the world of investing.
Absolutely. Before we move on, though, I wanted to touch back on that psychological aspect.
Sure.
How Graham thought emotions could lead to bad decisions.
Oh, definitely. He saw fear and greed as like the biggest traps for investors.
Mm-hmm.
Fear can make you sell at the worst possible time, while greed can make you chase those hot stocks.
Like those sirens in Greek mythology, luring sailors to their doom.
Great analogy.
Right.
Investors have to be wary of those emotional traps. One way is by having a plan and sticking to it,
Yeah.
no matter what the market is doing.
So have a roadmap to keep you on track.
Exactly. And another key is to understand your own risk tolerance.
Okay.
Some people are just more comfortable with risk than others.
Like some people love roller coasters, and others would rather, just relax by the pool.
Exactly. And there's no right or wrong. It's about knowing yourself and choosing investments that you're comfortable with. If you're constantly worried, you're more likely to make those bad decisions.
So balance risk and peace of mind.
Exactly. And that's where diversification is so helpful.
Right.
Spreading your investments across different areas, reduces your overall risk.
Don't put all your eggs in one basket.
Exactly. That's what Graham emphasized throughout his book.
Oh, so we've covered a lot of ground here. How does this all connect back to Graham's idea of intelligent investing?
Well, it's all connected. Intelligent investing is about being rational, not letting emotions take over,
Right.
and focusing on building wealth over time, not overnight.
So slow and steady wins the race.
Exactly. It's about making smart decisions that'll pay off in the long run. And diversification,
Yeah.
risk management, understanding yourself, those all play a part.
Now, we talked about enterprising investors before.
Yeah.
Those who are willing to dig a little deeper. What did Graham have to say about that?
He had some interesting ideas, like those net stocks we mentioned.
Right, where the stock is worth less than the company's assets.
Exactly. Can you imagine buying a company for less than the cash it has on hand?
It sounds almost too good to be true. How does that even happen?
Well, it's rare, but it does happen. It takes a lot of research and analysis.
Mm-hmm.
You got to be sure those assets are really liquid and there aren't any hidden problems.
So it's like, buyer beware. Make sure you're not getting a bad deal.
Exactly. That's why understanding the financial statements is so important.
Right.
You need to be able to really see what's going on.
It reminds me of that idea of the market being a weighing machine in the long run.
Exactly. The market might be emotional in the short term,
Yeah?
but eventually it catches up to the real value.
So patience is key.
Exactly. Intelligent investing is about making sound decisions based on research and a long-term view.
Not about getting rich quick.
Exactly. This has been a fascinating look into Graham's world.
It really has. As we wrap up, is there one key takeaway you'd want listeners to remember?
I think the most important thing is that intelligent investing is a mindset, not just a set of rules.
Okay.
It's about being rational, being disciplined, and always looking for that margin of safety.
About being a student of the market, always learning and adapting.
Exactly. And you don't have to be a genius to be a successful investor.
Right.
Just follow Graham's principles, and you can build a solid foundation for your financial future.
Well said. So there you have it, a deep dive into intelligent investing with Benjamin Graham as our guide.
Hope everyone enjoyed it.
Absolutely. We hope you learned something new, something you can apply to your own investing journey.
Remember, the journey never really ends. Keep learning. Keep asking questions.
And never stop seeking that margin of safety.
Exactly.
Thanks for joining us on this deep dive. We'd love to hear your thoughts. Until next time, happy investing.